Welcome back to the live broadcast. Today's topic is going to be, where are we going? So I know that many of the Mondays I come on and I do like Monday Aftermath, talking about what's happened in the past week, what kind of stuff you can expect, and do the microcosm of looking at the market. What we're going to do today is what we affectionately do in the real estate world, which is a quarterly trend talk. Trend Talk will give you a bigger picture over the last 90 days. So a 3-month period of what's happening in the market, because we really want to know. And the real question we're trying to answer for people is, what is the market going to do? That being the case, we have to always discuss leading indicators and lagging indicators. All of this data, for the most part, will be lagging indicators. Some of the data sets in there actually give you ideas and fall in the category of leading indicators. But by and large, what we're doing is we're going back and looking at the last 90 days of solds, pendeds, actives, failed listings, reduction percentages, unit numbers, all of that stuff to say this has been what happened, so that we can look to the future and say what is happening. All right. So for you Cheech and Chong fans out there, what is happening? That's what we're going to be working on today. All right, so I'm going to bring up Trend Talk on my screen, and we are going to dive into this for about the next hour and look at this stuff. All right, so here we go. Okay, so what you've got here, what you guys can see on screen, it should be, is the second quarter 2024 Metro Market Report. So first thing we're going to go over at a pretty rapid succession. So, and this will be recorded. So if you need to go back and check on any data, or you have something that's specific to you, you'll be able to look at that and kind of go from there. All right, so we're going to go right to my favorite slide. If you've ever been in a buyer's presentation with me, or a listing presentation, or you're in real estate and you've watched and been trained by me and seen some of the videos, then this slide will look familiar to you. So this is going to be the second quarter 2024 American Idol slide. Why do we call it the American Idol slide? Well, because when American Idol came out, these were the amount of people that would come and audition that felt like they could sing. When it got down to it, these were the amount of people that could actually sing. And you can see that this trend dropped down here until where the market right-sized itself around 2012. And then we got to this section of the great 2020 weirdness that we went through, and we will call this auto-tune. This is where everybody got themselves a DWA, a digital audio workstation with auto-tune, and then people like me who can't carry a tune in a bucket could sing. And now we're coming back into a market. Now, just to go over briefly what the importance of these lines are, the 6-month line is what we call a balanced market. This is the amount of inventory. The gray line is all the inventory that's available. The red line is the solds. This blue line right here is the interest rates. And then the black line is the months of supply, kind of charted on a graph of sorts. So what you can see here is, as we look at this, interest rates remained low. 2008 crash, the rates were about where they are now, actually a little bit lower. They came up a little bit, kind of fell on this line right here, where they're currently sitting just a hair higher than this. And then they started trickling their way down as we got through this. But it took 1, 2, 3, 4, 5 years before the inventory in this area fell below that 6-month period, or 6 months worth of inventory, where prices could really start to climb. And then we got here where everything just went bonkers. Then they had to start raising the interest rates to create a cooling effect on this. And here's where we sit right now, which is just in that 4 to 5 months if you were to blend everything together. Okay, so this is where we're going to set the stage with this. Now let's go to the next one. So this is cumulative month sales. What you can see is 22, 23, and 24. 22 was still during the height of the craziness. The trend line here of the number of monthly sales obviously fell in 23. We all felt that. Things got slower. And this year is tracking right along with it. It's almost a direct mirror. So that's all we're going to care about on that slide. Here's the monthly sales overall. That was cumulative, I believe. Cumulative monthly sales. Yeah, you can see the numbers down here. Boom, boom, boom. You can just March hit in 22, 11,000, and then they're mirroring 23 and 24. Mirroring. This one was actually down a little bit in June. we'll see what happens here. You can see the massive gap between these, about 7,000 units that did not close. All right, going back to here. So the monthly sales, and you can see that this was the height year of 2022. This is 23, and now 24 is looking like this. And this is that dip I was just describing to you, is where it felt like it started, spiking down. Like I felt really busy in May. June, not so much. July's been a trickle up, which will make for a bigger August. All right, so number of units sold in a different type of graph. What you can see is second quarter sales decreased by 1.1% versus second quarter 2023. And so this is quarter over quarter. First quarter, these were the numbers in 22, 23, 24, same going down second quarter. You can see that it's a small decrease from last year, obviously not massive decrease here. And this is kind of, if we're going to look at these percentages being static, if we're going to use the lagging indicator as a leading indicator, then we would predict that we will be somewhere in the 9,000 unit range here, maybe 9,800 overall. And then down here, probably in the sevens, if it's going to mirror that. Now, I'm not predicting that, but that is one thing that you may want to at least prepare for. All right, so going to the next slide. These are just the number of solds by price range. All right, so totals, as we previously discussed, we went from 23 to 24. We don't have all of the 24 number. Oh, this is second quarter, right? This is Q2 over Q2. So there's your difference. And then you go into the price points. This used to be a big price point, but there is nothing under 100,000. So you had 22 of them in 23 second quarter, and then 23 in 2024. Well, that's really ridiculous to say. That's literally number of units. Now we get into the 100 to 200K. You're at about 237 versus the 227, 1275 versus 1163, 51 versus 46. This is your entry level price point now, which is ridiculous, but between 300 and 500, really towards that under 4 is really where a lot of this is going to fall. And then you go 500 to 700. This is your move up price. Then your luxury stuff gets into here, which used to be here. It's all kind of trending. And then now we've started segmenting 1 million to 1.5 million so we could separate it from the 1.5 million plus. We even have some luxury slides because you really have to delineate, under 2 million from like the 3 and 4 million because the numbers will look very different. So just in general, change in the number of solds from second quarter in different price range. We have a drop. There's slight increase under $100,000, which are probably lots. Unless this is all going to be single families, then there's some junkers that sold. Then you've got a drop all the way across the board in what we call the entry level to the junk properties. And I don't mean junk as in garbage. I mean, if a lot of these properties under this price range are either going to be very small and very nice properties, or they're going to be regular sized properties that would fit into this category that need significant repairs in order to get up there. Maybe not here, but definitely here. If it's between $100,000 and $200,000 and it's a 3,000 square foot house in Cherokee County, let's say, that house needs work. That's just how that is. All right. And then when we get to the $500,000, some of what the drop here has gone here because the prices have pushed up. So that's how I would read that. And then you can see an increase here and here. More of these transactions are taking place, which you may want to say, if you want to be where the percentages are, not necessarily the units, then maybe here. Maybe working on luxury might be your best bet. All right, second quarter. So this is going to be the supply. So we call supply when you hit 6 months, and we're going to define that. Somebody asked me this week. If we're going to do a supply run and the supply it stops, meaning it becomes where nobody takes any more listings based on the current days on market of how long they're taking to sell. How many months would it take to sell everything on the market, assuming everything would actually sell? So let's say sell, expire, or withdraw, right? So that there's nothing left. And that gives you a 6 month supply is a balanced market. Anything in the green will be balanced. Anything that goes into the yellow crosses over from balanced into 6-7 months is balanced into the red, which becomes a buyer's market. We are starting to see a buyer's market in certain price points. We're inching our way there, at least to balance. So we'll take a look at that. But remember, as the days on market increase, it will affect these numbers. Meaning, if the average days on market were 8, and you had 8,000, units on there, the amount of months it would take to sell that when the average days are 8 is going to be a lot less than if you have 8,000 units and the average days on market is 90 days. Well, now you're going to have a much larger supply for the demand. So it calculates all of that. So let's go back to the screen. Okay. So here is the supply comparison over last year for the same previous period. So second quarter to second quarter. Slight drop in this one. Slight increase from 1.5 to 2.3 here. A pretty sizable increase here. 1.4 to 2.4. Here's going to be your median areas between 300 and 750. Let's go 300 and a million. You're basically 2.4, 2.4, and 2.5, where you were under 2 in all of these categories. You're now slightly over 2. So we're headed in this direction. All right. When you get to the million to 1.5, you're still in a buyer's market. When you get to the 1.5, that you were firmly in that 5 months, but you're not 5.9. You're approaching this line. Total balance is really 2.6, so it's still pretty low. Percentage of original list to sales price for the buyers received. This just basically tells you stuff is selling. The stuff that is selling for what it's asking for. There's some price reductions here and here, a little bit here, 99. These are 100 all the way across the board, which is a little better than last year on some of it, but just infinitesimally small, like not even really a marked difference. All right. So when you come into median days on market, 24 is on average, 25. So we actually dropped one from last year. We climbed clearly from 22. Look, 11, 8, 15, 28. This is where we started seeing the price increase. Like this jumped up. But average, because of these, it was 9. Now you're at 25, back down to 24. So we're tweaking in that direction. Okay. So here, what we're looking at is median days on market by price range. So this is going to help you look at price range. If you're like 500 to, let's say, $650,000 property, 16 days, it is up, which is funny because this last slide shows it being down. Oh no, my bad. It's down from 22 to 23. 24 isn't here. We are actually up. We're up here and here. But these two, because of first quarter of 23 being what it was, is actually down in terms of the averages. Okay, so moving on to the price range. Median days based on price range. We already talked about that. We're going to go to median sales price. So this is median sales price is the middle of the road. So if you have highs and lows, of course, the average will be a blend of all of it. Median, they cut off the highs and the lows and they look for an average, which is where you get median from, which is the majority of the transactions. In first quarter, 440 is where we hit. We hit 477. So this is showing a very clear appreciation. Here we actually had a drop from 455 to 450. This remained flat at 410. These climbed from 440 to 450 here, 440 here, and then kind of settled out at that 430 mark. Right now, we're running an average of 460 year to date. Remember, we're missing these two columns, so this number will likely change, but you're still showing a percentage of appreciation. Change in the median sales price. You saw the drop actually take place. You had this big old spike through this time frame, and then a flat drop, a slight decrease, a little bit of increase. But now first quarter 7.3 and 6. These are still really, really solid numbers. If you look back pre-pandemic into 2019, 3s, 2s, 4s. 4 is sustainable. 2 was actually quite flat. but we're still riding high above those. Annual median sales price. This is just what it's going to look like. So you have a nice big chart across the board of what it was like in 2005, 6. This was the height of the market where everybody thought we were crazy. We dropped off into this area, even though technically this was undervalued property. As it future paced itself, here we sit. All right, change in the median sales price. This is just going to give you some of the percentages. We had that 21% climb. I'm sorry, 20.6 in 21, where you were at 9 here, 13 here. These are the big two numbers that affected this stuff. But you can see we rocketed out here in 2012 to 2013. We had these reductions of 12, 14, 1, and 16. And then we were 7 and then 35. So realistically, the difference between 2012 and 2013, we have not seen a spike like this yet. Not even here, where if you go from 19 to 21, I guess you're going from 4 to 20, where this is 8 to 35. So, all right, more of the same data there. That just shows the sales to list price, a little bit of room to negotiate. We call this the Skittle slide. This just gives you the median price of properties over all of these years here. Don't want to spend too much time on that. Failed listings. All right, so let's talk about that for a second. So you see listings going on the market, like, well, why isn't my listing selling in 5 seconds flat if all this data is here? Because price condition. I have to keep saying that. So if you take a property and put it on the market, if you're a seller, and you're like, okay, the price range is going to be between $400,000 and $425,000, and you're saying, well, let's try for $430,000. I can always come down. Then you will fall into the price reduction category, or if you hold at that $430,000 and let's say don't make any adjustments, and the market tends to doesn't move fast enough in your direction, you end up in these failed listing percentages. So as you can see, 40% under 100 grand, 35 under 200 grand, till you get to 330%, which is up 10% here. 18 to 27, almost 10% there. 19 to 25, you can see this. The percentages have actually grown quite significantly. We're basically up 8. Yeah, flat 8% in the amount of failed listings. Price reductions, the other conversation where you're having to do this. You're seeing 40% of the time, 32% of the time. This one, obviously, we don't have the data in here for this as far as this, but it was 40% here. It's actually down 35. So it's improved in some sense. So if you have a listing on the market and it's sitting, it may be pricing or condition. You can always increase the condition and keep the price the same, or you can decrease the price to accommodate for the condition. Effect of percentage of sales to list price, you can see it's pretty negligible. More of the same. Going to skip that one. Incidence of price reduction, about 32% overall. Your highest price points are under 300 grand. Those are the ones reaching for the stars. Usually this is condition. If they're going to put it up under 300 grand and they're like, you can't find anything under 300 grand, so let's go ahead and just put it up for 287 when it should be 240, right? And that's where you end up with those numbers. Reduction percent taken by price range. So this is your price ranges overall and the amount of that has reduced in the price reductions. You've got in your median stuff, it's a lot tighter. It's your really cheap stuff that's overreaching or your really expensive stuff. All right, price reductions across the board. No price reduction required. You see the 100 and these price points. This is if I'm going to see if I can say this correctly. This reflects the ones that sold that didn't need a price reduction. If they sold for, they went on the market, I'm going to make up a number, at $500,000. They never got a price reduction and they sold. Doesn't mean they sold for $500,000. This data would tell us what did they sell for. In that example, if we're looking here, then that would have been 94.3% of $500,000 with no price reduction. And this would be, with a price reduction with no price reduction. So that's the differences that you're going to see. So if it had no price reduction, they got what they wanted. If it needed a price reduction, you're looking about 6 to 10% in an adjustment. 1.5 million, you're looking at quite a big one. So that's the difference of getting the price wrong, 6%. What's 6% of your price point? See if that's what the difference between you and what your listing agent is recommending. That may be what you want to do. All right, price reductions effect on days on market. If it needed a price reduction, look at the grays. Your average is 75, 164. I mean, it's a big case here, 14 days versus 164. And here's the stuff you're seeing go multiple offers across the board. This is our game board slide. If you've been in a presentation, you've seen this for sure. This particular one is second quarter in all of Metro Atlanta, 11,000. Looks like they sold for about 99% if you pour them all in the same bucket and stir together. So we want to look at the stories here and here. What you're looking at over here is in the green, they did everything right. They got 100% of their list price. They did it in about 8 days, and that represents 62% of the market. Over here, they did it wrong. They fired the agent, hired a different one. That's about 17%. You can see they're off by almost just under 9%. Now, let's say they stuck with their agent and they did do the reductions over here. That's 94%. Here's the blend between the two, which is the other 30% of the market. This and this. That's where actually really these two. But 75 days. You can see over here is 140. So it's a significant amount of time difference. So there you go. Trying to skip down to some good stuff. All right. So this is a great slide that shows active listings in January of 2009, June of 2019, and the month of June 2024. So we went from here to 50 cents on the dollar. I shouldn't say dollar, 50 cents on the number. So we cut it in half, and then we're still below that in terms of fewer choices. Days on market are actually down. Distressed sales are still really, really low. Number of units sold, you can see this big difference here. 5,600 versus 3,400. So that's less actives in the market. Median sales price, 300, 455. Median days on market, 22 versus 26. So the median days have actually gone up a little. Just things happening slower. Percentage of price reductions, 36. Failed listing percentage is 29 versus 27. This is pretty flat. And that kind of gives you the overall of the Atlanta market as a whole. Now let's take a look more specifically. If you want to see Cherokee County, here's the numbers here. These are the numbers of units sold. You can see the different areas and how that helps. You can see the percentage changes. So if you go into the Northeast Cherokee, it's up by 35%, where Northwest Cherokee is only up by 5%, and Southwest is down by 22%. Southeast is flat. So this just says there's less units trading hands, which means people are staying here, but they're moving into here. That's just your counties. So you can see the percentage of numbers, more than 5% here, and then drops over here. Median sales price for those areas, you'll be able to see Northeast, you got 693,000. So this is where you're getting some acreage and some luxury builds in the ball ground area. Everything else is 450s, 460 in, that kind of 482. So that's all fairly relative until you get to this, which kind of really blends all three of these into the 500, but it's good that you see the breakdown. Change in the number, percentage change in median sales price. So there's the percentage change. How much it's gone up? 5%, 8%, 12%, 18%. Boom. Looks like South Forsyth is jumping like crazy. Got some spike areas here. But I also do want to point out Vinings is down by 11%. You've also got Sandy Springs ITP, which is inside the perimeter, down by 9%. And so there's some adjustments happening there. Days on market, Vining 63. Wow, they're still, still well within a seller's market, but significantly higher than most. 79 down here in what looks like Southwest Atlanta. Cherokee County, we're at 46 in Northwest. So this is where you're starting to see stuff sit. All right, so versus the Northeast. So those are Northeast, and then you got the South. Stuff still boogieing down here. There's that same data reflected in numbers, 58% versus 3.4. There's the change. This is what they're getting for the houses, the ones that are selling. 97, 98, 98, 98 in this area. Now, it blended out to 100, but you have to remember this is the ones that had multiple price reductions, sometimes multiple listing periods, as well as the ones that didn't have any that got 100%. So if you blend it all together, you're just looking about, worst case scenario, 3% off of the asks, the original asks. All right, points of change. We've got, it's marginal, right? Not really worth spending a whole lot of time on. Incidence of price reduction, 42, 39, 39. So they're pricing it right 60% of the time. That's what it's boiling down to. Points of change with price reductions, see all that. Month supply of listings, March 31st. Boom, we can see all that. Still 3, 2. So once you climb towards that 6, that's your red flag of market prices softening. All right, percentage of multiple listing periods, failed listing percentages. 50% of everything in Vinings fails. 1 out of 2 listings. 34. So the highest areas are getting 34 and 32 in Cherokee. And southeast and southwest Cherokee, you're getting 18 to 50. So you're below 20 down here. You're above 30 up there. So I think that's significantly interesting. And then we have blank slides. So let's kind of recap. As we go through arguably some boring, a lot of data there, we really need to just ask ourselves, what is this telling us and what is going to happen with the market? So based on this data, what I can tell you is with the trends heading this direction, we're going to see more of the same in the rest of 2024 that we saw in 2023 and the end of 2022 when the interest rates started to decline. It looks like we're going to have some appreciation. That appreciation might soften a little bit where it's holding at that 8%-ish now. Maybe it drops to the 4%-ish by the time we get to the end of the year. I don't know. And all of this is, well, we're going into what is arguably a volatile election cycle. The national news has been absolutely insane with the amount of historic things that are happening. All of these things can play a role in this. Now, there's 2 things about that. One, are we desensitized to major things happening so life just continues as normal? Or will the markets start rocking in an increase in confidence versus a decrease in confidence? 3 world major events that have taken place is one, an attempted assassination of a former president and current candidate. Number 2, the sitting president decided not to run for re-election. Number 3, it's not the first time, but another time that candidate has come in, the front-running candidate, I guess left to be confirmed, Kamala Harris for the Democratic National Convention when that takes place, is now up and running. All of these things are major news. So there's so much stuff happening on a global scale that all these things become microcosms that, well, they affect our small microcosm. And how that usually happens is, and I tell this in pretty much every live broadcast that we do, is what happens on the global scale affects the markets. If investor confidence in markets, like the stock market and other things, money flees from that, oftentimes it will run into the bond market, which it finds to be safer. If the bond market is doing better, then interest rates tend to drop. Now, they can only drop so far because they can't really go below what is known as the Fed fund rate, which is currently somewhere in the fives. So if the Federal Reserve is loaning money to banks at 5%, then in order for the bank to make money, they have to loan it. I'm just making up numbers now. 5%, 5.25 means they make 0.25%. We all know that that's not really what the banks are looking to do. That's why you'll see rates that climbed into the 7s and the 8s when consumer confidence was fleeing the bond market and the stock market, which can happen simultaneously. But if the consumer confidence was, I don't feel good about the long-term projections for our country, then rates climb. If the volatility, creates, let's just say, the person that you want to see elected is running high in the polls, so that makes you go, I feel good about the future of our country. I feel like it's going to go in the right direction, and money starts flowing into those markets, then those rates can drop. Now, obviously, the Fed indicating whether they're going to increase the Fed fund rate up or down also affects their projections on investing, and the market reacts to that. We were told originally we would have 3 cuts on that Fed fund rate this year. We have not seen any. And based on the jobs report, they've come down. They think they're going to do 1 this year. It remains to be seen. I don't know what to tell you. That being said, what I think is going to happen is the volatility is going to curb some of the overall appreciation. I don't think it's going to continue to climb at the 9 and 10% rate. I think we will still end the year with significant appreciation in Cherokee County, something that you can write home about, something that is still decent. And I also think that we need to watch markets like California, Nevada, and even Ohio. Markets like this, we usually see trends that start there come this direction. So and Florida's another one. As those markets begin to compress and or collapse, then there's usually a clock running before it will visit here from a price adjustment standpoint. So that really is going to be what we have covered today. It does show a strong third quarter is likely going to be what's going to happen. We have noticed that things seem a little bit slower. So here's what I would say to you. If you're in the market to buy a house and you don't plan on moving in the next 12 months after you purchase this next house, then I think it's a great time to buy. Why? Because the properties clearly are showing to be appreciating, meaning the longer you wait, the more you will pay for a property. Sure, you might save on the interest rate, but you could also buy today, and then when interest rates come down, when that happens, you just refinance it and you already have the house and the savings. The average appreciation for Cherokee County over the last decade is about 9% per year. So if that's true, and the house you want today is $500,000, and you want to wait 2 years to get into that because you're waiting for interest rates to fall, let's just use the conservative rate of 4%, not even 9%. That means in 2 years' time, that price will have gone up 8%. What is that number? Well, that's around $40-some thousand to look at that, because 10% would be 50 grand, and we're at 8%. So you're going to pay 40-ish thousand more dollars for the same property when you can buy it today. Rates are sitting somewhere in the 6s. I just saw something come across that showed APRs for in some cases at 6.375. Obviously, there's some origination fees baked into that, but that's what we're seeing. So if rates were to drop, you could buy and then refinance. Let's say they go back into the 4s. I doubt it, but let's say they go back into the 4s. If they did, you still paid 40 grand less than you would for this same house. And so that's one good argument. If you're thinking about selling and you're concerned about selling out of a 3%, rate that you have and buying in another market at the 6% rate, I understand. If you don't have to move, you may not want to do this. Like if you're like, this house actually could work for the next 10 years of my life, I really don't have a reason to move, then you fall in the category that I say to people all the time is nobody wakes up and says, you know what, I think today I'm going to get some coffee and go for a run. What else should I do? You know what? I'll buy a house. They're not impulse buys. They're either investments or they're a place for you to live and have a lifestyle. If you are looking to make that move because you eventually want to be somewhere, this may be the time for you to liquidate and to acquire and then work towards that, because the market is still holding high enough where you can sell the property before some kind of cataclysmic thing happens and we have a dip in prices. Sure, you'll be able to buy cheaper, but you're going to sell cheaper, right? That's not necessarily the world you want to be in. So from a buy-sell standpoint, I think we're still in a solid window. From an investment standpoint, as long as it cash flows, it's definitely a solid window. If you're a flipper, then it's all about your construction costs. Those have gone up significantly, so some deals are less appetizing. Let's just put it that way. If you're a wholesaler, then it's just a question of where do you find your deals, right? You need to get out there and find them. If you found a good deal and you're looking for an end consumer, you can give us a call because we probably have some end consumers. We don't mind assignments of contracts as long as they're clean and the properties are worth the money that the people will be paying for them. If you're looking to find investment deals like this as a wholesaler, we already are set up to handle that on our side, so that's really not a fit. So that's kind of what I would leave you with right now is I anticipate our hyper-local market to hold it together. I do see that the United States market as a whole will begin to soften a little bit, especially in areas like California, Nevada, and Florida. Those areas are usually going to be first to the race to have problems. So keep your eye on those things. Watch for inventory to climb above that 4 and 5 months across the board, and that's going to be your best indicator. So I hope this was helpful. Again, if you are interested in buying or selling or investing in real estate, please give us a call at Ursula & Associates. We would love to talk with you about your goals and set up some parameters to find those right deals for you. Until then, we'll talk soon. Thanks so much for being here. Appreciate you guys.